All right, guys, let's just quickly do a mid-session update here in terms of risk sentiment and movements across major asset classes. Look, it's been like watching paint dry, right? Very little going on that's getting us excited here. And that is to be expected because we've got such a boring economic schedule this week. I mean, we had some fun yesterday with the RBA, nothing major. Not expecting huge shifts from the Bank of England tomorrow either. There could be some dovish elements there that could surprise. We'll obviously touch on what they are and how we can look to exploit them if that happens. But apart from that, we have GDP data coming up for the UK on Friday, Canadian jobs data, and the University of Michigan sentiment. That is about that. So in a week like this, we've got very little going on or very little to be excited about. It probably shouldn't surprise us to see the markets just, trading very range bound, very muted, very lackluster, and that's exactly what we've been seeing. In terms of equities, very little change from our early morning update. US equities just kind of sitting idly by, either flat, slightly negative. European or EMEA equity futures still the better outperformers here. They are trading very close to session highs for the Euro Stoxx 50, as well as the DAX. Volatility continues to grind lower. That's about that for equities. Very little new information, very little from a fundamental point of view. It's basically just Brownian motion right now. In terms of the bond market, same story from earlier today. Pressure to the downside, 2s, 5s, 10s. That means yields pushing to the upside. I don't think this really changes the view. The reason why we like yields lower here in the, let's just call it the intermediate term, couple of different reasons. The first one is just looking at the economic data, right? Whether you look at the soft data or the hard data in the US economy, it's been slowing. Whether you take a look at things like the labor market, whether you take a look at things like inflation, there's an obvious slowdown happening right now. Whether this slowdown is a dragged out affair is still up for debate. It might just be a little bit of a flash in the pan before we start seeing data surprising higher again. But for now, you've got growth slowing, labor slowing, inflation surprising to the upside versus analyst expectations, but not really surprising to the upside from a trend point of view, right? If you take a look at this chart, there's very little to be stressed about inflation right now. Can this change? Of course it can change. If this starts to move in the wrong direction, that's going to get everybody's attention. Right now, though, with where we are, with what we know at this stage, I think the Fed's decision last week made a lot of sense when you look at a chart like this. Let's not get carried away by one or two upside surprises when the trend of inflation is still intact. So with all of that said, I do still think that the most likely path of least resistance for yields remains lower here for bonds to the upside. But again, like we said earlier in the week as well, we've got the gauntlet coming up in terms of US data, right? We still have US CPI to deal with next week. If that is another massive upside surprise, then all bets are off, right? We probably see yields ripping back to the upside, the dollar ripping back to the upside. So there is a lot gunning on those inflation data points. But until then, the bias remains tilted to the downside, in my opinion. Now, in terms of commodity markets, look, still a mixed bag. We have seen a little bit of recovery. To be fair, let me just quickly show you guys in the precious metals, bit of an upside in gold, a little bit of an upside in silver. But for the most part, commodities still pressure across the board. The two biggest ones that we need to pay attention to, I think, right now, especially for its intermarket analysis impact on things like the Aussie dollar, is copper as well as iron ore. I mean, if you take a look, you don't have to look at correlations. That's normally the case. But if we look at the hard data, we can see that there's, between copper and iron ore, it's obviously a strong positive correlation with the Aussie dollar. That makes sense from an export point of view. And if you just quickly look at a simple view, looking at the Aussie as a index, the Aussie dollar, as an index of the Aussie dollar, as opposed to just the Aussie versus the US dollar, you can see that as copper and iron ore is rolling over, we're seeing that pressure playing out into the Aussie dollar. So that's just something worth keeping in mind from a commodity point of view. While we're on the Aussie then, let's take a look at FX. Again, very little change. The dollar's still the strongest. The yen still the weakest. We're seeing a bit of interesting upside here for sterling, which is currently, just making me very happy that we decided to take some profit on that euro sterling upside trade that we were in from a couple of sessions ago. Let's wait and see. That's the bottom line. I'm not going to be spooked into a trade here for sterling today. I'm going to wait for the Bank of England. That's going to provide us, hopefully, with the next tradable opportunity. And if it doesn't, we'll stay patient on it. Only trade things that make sense, especially in an environment like this. Apart from that, Everything else just kind of chugging along. Very little change, very little to be excited about. Again, we looked at the earnings for today's session, pretty light. You know, if you're trading this as a single stock name trader, then obviously you're going to be focused on it. If you're trading it from an index level like me, probably not that important, right? Yes, important names by themselves, but from an index perspective, not something that you would expect to really rock the boat. The other thing to watch out for is obviously additional central bank speakers coming up. Very little today though. Let me just refresh this page. We've got Jefferson coming up. We've got Collins coming up. We've got Cook coming up as well. So interesting. We'll see whether they have a similar view like we saw from Williams, from Barkin, from Powell, from Kashkari last night. It seems like the overall bias for Fed speakers right now is a message that yes, inflation came in higher, and yes, we're paying attention to that, but the higher probability is that we stay higher for longer or we cut rates. Those are the two options right now. Nothing really, forcing a view of higher rates here from the Fed speakers so far. And that means maintaining that prior view that we started the week with. So that's just a quick look across major asset classes. As always, any questions, don't hesitate to let me know.